Yes, indeed. Indeed. Back indeed we are at another Friday, August 20th, 2021. There you go.
Yeah.
What a week it's been. We were just chatting off air. It's been a little bit hectic pace for the week. So it's nice to sort of land a little bit and hang out with you, mate, have a glass of wine and have a bit of a yarn to everybody.
Well, mate, I think we both had pretty much the same day where we sat down at 7 o'clock in the morning and then looked at our lunch at 3 o'clock, but didn't get to our lunch until 4 o'clock, and then thought if we don't have our lunch, it might be a messy evening.
It could be. It could be. We've got a few people already jumping on. So good to see you guys here. James, mate, good to see you. Christina, already got a glass of wine. That's good. Jeff, how are you, mate? Good to see you here. Give us a shout out in the chat if you're online. A few people jumped on now, which is awesome. And great to be hanging out with you guys on a fabulous Friday. What wine today? I've got a little Pinot Noir from last week. It still tastes all right, Andy. I only drink very little anyway. But anyway, there you go. Have you got something fresh, Andy? Pinot Noir called that.
I swear to God, it is unbelievable that you function on such a high level and you literally try and poison yourself once every couple of weeks. Mate, I've got the older Grant Burge, borrowed from the old man today. Old Vine Shiraz from Barossa. It's getting to that time of the year where you get rid of the rest of the Shirazes that are in the fridge because it'll be Pinot Noir and Chardonnay for the summer to come.
There you go. Well, Christina's got what do you got? She's got a Shiraz cab going on. That's good to see. Yep. The Longhorn Creek. Yeah,
lovely.
Let us know. Yep. And looks like Laura's got a glass of wine too. So great to have everyone here with us tonight. And if I've missed you, we got Robert. We've got Michelle diving into a few people here as well. Bob, Tony. There we go. Tony's got a bit of Scotch and ice. And the Cuban cigar. What a good afternoon. I hear that goes well together. As a mixer, and Michelle's on the lemon ginger tea, but that's the way to roll. Whatever drinkers you fancy. There you go, team. As you go, as we go, and we didn't get an alert today. Alison was saying, but there you go.
I noticed that as well. We'll have to have a chat with our mob in the tech companies and find out what's going on in the world.
Yes, well, sometimes we get the alerts and sometimes we don't, but fantastic to have all of you guys here as we do a little bit of an intro kickoff. Most of you guys know us, I think, by now. But if you don't, Andy Fenton over there, Jason Witten over here. And we get together with a bunch of cool people, have a glass of wine on a Friday, started mid-COVID or at the beginning of COVID, supporting our communities, the real estate world and the share and financial planning world and finance world and Andy's side, small business. And we thought we would sort of demystify and support people via a quick debrief at the end of the week. And we've actually turned it into a bit of a thing. We enjoy a glass of wine, a bit of a chat, and we invite you guys along too. I hope you guys enjoy it. Both of us have been 20 plus years in our industries and try and help you guys and ourselves debrief the week and make sense of information, what stuff we should pay attention to and what we shouldn't, and maybe what to look at into the future. So welcome along if you're here. And there's usually we try to stick to a bit of a system or a theme in the in the Friday Wealth, Wine and Wisdom. It's usually a little bit what's in the news. And we spend some time going, hey, what's been happening out there? We might be a few decent articles or bits of information. We like the idea of maybe having a chat about things we should know. There's plenty of things we should all know, and we've had some amazing comments in the chats from you guys as well. And it's always great to have a two-way street in this conversation. And if you've got any questions, as always, whack them in the chat. We will give them a whirl also. So as we go, and a few people already in there, mate. Alison's got a little Moscato in the glass this afternoon, which is good. And Jeanette's dialing in. Good to see you, Jeanette, mate. And Bob's already on. He reckons there's a bit of stock dropping. Could be a good time to buy. And crypto is having a bull run. It's all interesting out there. And we might dive into a little bit of that today. But Andy, why don't you give it a kickoff? What do you got for everyone today? Anything in the news that's interesting on your side of the fence,
mate? Well, as we always do, bit of a kickoff from our mate Yogi Berra to start things off. You better cut the pizza into 4 pieces because I'm not hungry enough to eat 6. And I think that it's a good theme to get things started today because I thought, well, let's have a little bit of a look at some of the things that are in the news at the moment, which do or don't make sense. And there's a bit of a theme that's going to come from this over the course of what I've got to say. And I think it'll dovetail into what you should know later on. But Sydney Airport, interim net loss dives into $97 million. $97 million net loss for the Sydney Airport. Not really surprising, Jace, because not too many planes flying out of Sydney Airport.
Not a lot going on in Sydney Airport, Andy.
No, apart from the coming back from the Olympics. But outside of that, it's reasonably quiet. You could go into the international terminal. You could probably have a good ballroom dance in there and not bump into a single soul. Not even the deep cleaners are in there at the moment. So one would say, well, from a stock perspective, Sydney must be doing pretty poorly. Wouldn't you think so? So here's the chart for the last year of the Sydney Airport stock price. We spoke about this early.
Zoom in on that for us, Andy. Zoom in on that. This is golden, folks. You've got to pay attention to this stuff. This is. I did a little segment this week saying the markets are never rational; they're always irrational. But here we go. This is interesting. Tell us what this means, Andy, because I was going to ask you about this. Was on my list. This is on my list right now. Yeah.
Mate, we're sharing a brain, and. And you would be forgiven if you thought this is ludicrous and this doesn't make any sense whatsoever. And for those of you who watched us a long time ago, it's rare that I come out and do you should buy this. And I don't think I did say that. I think I said that it's certainly worth a good look. And that was well over a year ago. So for those of you who did have a good look, probably around about 50 or 60 or maybe even 70 or 80% up because it was lower than $5 when we were talking about it.
Yes, it was, mate. Yeah.
And so sometimes you've got to look a little bit deeper. And as I said, you'd be forgiven for thinking that this is a little bit unusual, given that it's a $97 million loss. But ultimately, stock is well and truly up. Now, there's a big kicker that happened there, Jace. It just went vertical.
What happened there, Andy?
Well, it wasn't planes taking off, that's for sure. Right? They have but you would think so, wouldn't you? You would think so. And Flight Centre is back on the radar as well, just as an FYI. So another stock to watch in this space. But this was after. What would you think would be what do you think would happen after you're posting a $97 million net loss?
I know. Would you get some input of capital? Would someone want to buy in, loan you money, get cheap resources? What would happen?
Pretty much. Oops, that's Jace, I may not have put the other slide in there.
No,
maybe I've misordered them somehow. Let me just have a look, see if I can drop it in there. It's around here somewhere. Well, I can't, but what I can tell you is Sydney Airport rejects. So after a $97 million loss, Sydney Airport rejects a takeover bid from a consortium. Sydney Airport in Australia has rejected a revised takeover bid, $22 billion. That's $16 billion US. From the Sydney Aviation Alliance Consortium. The proposal was for a stapled security in Sydney airports as an indicative price of about 8.45. So as you can see on our slide here, it jumped up pretty much to what the bid price was reasonably quickly. The airports previously rejected a takeover bid back on the 5th of July, which is where that was. They revised the bid, came back in, bidded higher. Sydney Airport said, no, thank you. And this is an example of, obviously it's the remobilisation, right? Because in a world now where supply chains are disrupted, in a world where there are so many uncertainties, people start to look for what are the certainties. And some of the certainties around at the moment are, well, when they open the borders, people will travel and they will travel en masse.
Yeah. Well, you would think it'd be almost ridiculously it would get busy for a time. Everyone's got to get it out. Like, I've missed out on 3 or 4 holidays. I've got to fit them in, maybe,
100%. And when you've got long-term leases like they do over the infrastructural space of Sydney airports, well, you're actually owning a license to print money in the future. And again, going back to long-term interest rates, when you have interest rates basically down at 1%, you can borrow at 1%. You don't have to be able to push a significant return, and you will push a significant return on this asset when it gets back into mobilization and when the planes start to go. It's still collecting rent from different suppliers, and it's heavily subsidized by the government. But as soon as it's allowed to, one thing that we know for sure is that when they open up the borders, people will travel, and we will travel en masse. And
money will be invested, spent in these things, and that's why people are getting in place for these opportunities, Andy. Tell me, do you know off the top of your head? I've just got a question, maybe for everyone. Like, what would be the multiple that the market is pricing this at for a future income? Is it like a 5 or a 10-year income, or is it a per annum multiple that this thing's worth $8 billion? Like, where how does it get priced? Is there something you can give us some insight on this one?
Well, at the moment, you've got. We don't actually have their PE listed in there at the moment.
Price to earnings. Yep.
So, look, I haven't done that much research into the bid and the takeover as to what they're looking to get out of it, as far as what that's going to be worth over time. They will be looking at north of your 5% profit or margin over where they're looking, as far as the long-term rate of which they'll be able to get over what their debt funding is on it. But it's almost impossible to tell at the moment, because the multiples, when it comes to markets at the moment, they have never been higher. Never in history have they ever been higher. The kind of, the price to earnings never has it been lower, if that makes sense, because the prices are now so high. But it's a difference between the cash rate, which is the risk-free rate of which you can invest, being 1% or lower. So anytime you can derive a return that is higher than that, you're going to take on a risk for it. And these are major infrastructural assets. So if you're buying at 1%, if your borrowing costs are at 1%, then normally you'd be looking for significant dividends that are sort of 5 or 6%. That's just as a dividend of the profit. So that's a portion of the profit. So you'd be looking at well north. I don't know where the P is on it at the moment, but I would say that it's the highest it is the highest P that you've ever seen. It's the highest price that we'll ever pay for the earnings multiples on this, bar none. I can't comment exactly because I don't know the figures, so I'm sort of stumbling looking at some of my reports here to see if I can find it. But
but that makes sense, right? It makes sense, and we're seeing that show up in the real estate game as well. The rent, to price ratio, you'd call it PE ratio, for comparison. It's low right now. It's getting extremely low because the cost of finance is lower. I'm going to show a little bit in mine what's in the news about the cost of actually a mortgage now is, at 20-year lows, and we'll chat about that later. But and one thing you mentioned here, which is good, because I think this is a really important thing for all of us to understand, Andy. These deals aren't being done by someone grabbing a bunch of cash, right? There is debt involved in purchasing these assets, right? So the money is being used to buy this. It's comes in the form of debt, right? And debt structured deals. I remember you telling me about your life as a reformed banker, but back in the day, debt was a good instrument to create great deals because money needed a place to go to work, right?
100%. And look, it's looking for those homes at the moment, because you can't earn the 1% and expect to be anywhere other than behind. And that's the problem at the moment. So anywhere where they can see a long, stable return, and we talked about infrastructure ad nauseum over the last 12 months, And so any time that we're going to be looking at semi-government backed or government backed long-term yields, and that's what airports are. They're long-term assets. They will go up. That they do have a bit of fixed pricing in there, as in they can't necessarily raise their rents to the airlines too aggressively. So it's very much a fixed pricing market. But assuming that we end up traveling again, and most people would go that that's a pretty good bet. It's just the question mark is when. Like, when are we going to be doing it? Not if and to what extent. They know that it'll be back as big and as bad as it was before. So they're going, well, how long could we wait this out? 1, 2, 3 years? Yep, no problem. Can we continue to get debt funding to do that over the next 1, 2, 3 years? Absolutely we can. Can we lock in that debt for maybe the next 10 years? And the answer is probably yes, they will be able to do it. And so they don't have to earn too much in order to be able to get their return back. So this is what I would call potentially, now not to your average Joe investor, but to the acquisition, this is what you'd almost call a sure thing. Now they'll have built that into their pricing mechanisms, and they'll have got their expectations out of it. But we are seeing this all around the globe, and it's probably happening a little bit later than we initially thought about it. And like Jason's like, hurry up, get with the travel. I've got shares in Webjet. Get people traveling again.
Well, and again, I like what you're saying there, Andy, because many of us might be struggling to go, oh, okay, in the moment, oh yeah, when, it could be forever, but it's not going to be forever. It's going to be within 2 or 3 years for sure. If it was 4 or 5, that would be, a long time, but it's before then. And the same thing for me in my neck of the woods is immigration, people moving to Australia en masse. The government has a mandate, a policy to catch up on how many we haven't had in the country. And we actually have a skill shortage in the country, even though our jobless rate at the moment is not falling. I had a conversation with an accountant who specializes in trust fund audits for property management. And there is over 1,000 trust auditor jobs on the East Coast alone. And they said they have not had an application for their job here in Queensland, where I am. So while, I'm going to talk about this one a bit later on about the jobless rate fell, but really did it. We actually have some challenges in the skills we have in the country to match the jobs that are up for grabs. So, you're saying, okay, well, when do we get traveling? As soon as anyone can travel, they'll be out there. They'll be often. I will be. I can tell you, the moment I can go, I'm like, poof, gone.
Can you imagine it?
Yeah. So there you go, mate. There you go. What else you got, mate? What else is going on out there in the news?
Well, as a part of the theme about what's the right price, what do you pay for it? Here's a bit of news for you, mate, and I'll take you into something very, very interesting. How often have you heard this, mate? The handbag, Jace, it's an investment. It's not a luxury, but it's an investment. It's an investment. And we have the same thing with a few boys' toys and what have you. But mate, it is an investment. So have a look at this. Old mate, Scott Cutler, this is an incredible company. And I'm going to ask you a question, Jason, for everybody in the audience. Actually, I'll ask you the question now. What would you reckon would be the buy price for a pair of brand new, never touched Air Jordan 4 M&M models? And I might have a look and see what the other ones are, because I think that we are getting into a different, and we're going to go into this maybe later in the what you should know. Jordan 4 retro M&M Carhartt. What do you reckon they'd be worth? Whack it in the chat. We can even go down to the Jordan 11 retro premium.
Jace reckons 5K. Jace reckons 5K. Jules is going, what the hell is that? It's a pair of shoes, Jules.
It's a pair of shoes. So this is really interesting. So we've talked about Bitcoin, we've talked about cryptocurrencies, we talked about NFTs, non-fungible tokens, which I think will be an incredible marketplace of the future. So StockX, Google it, have a look, incredible. StockX CEO here, Scott Cutler, was having a great conversation on Bloomberg this morning, and people are buying these things quite literally for an investment, Jace. It is, and what really struck a chord with me was a comment that he said, and he said that people see value, kids and the younger generation see value in different ways and value in different things.
Yes.
And when it comes down to what money is, and we'll talk about this later about the evolution of money, but when it comes down to what money is just the evolution of the barter system, which then basically says, well, it's a store of wealth, and the store of that wealth is ultimately based on the value that people perceive. Currency then changed that, but potentially we're going back to much more of the old system of, obviously it is stored based on the value of the person who is looking at it. So what do you reckon, Jace? What do you reckon those shoes would cost you?
I'm the beholder. I reckon I'm going to be with Jace O'Neill here. Bradley Pop reckons 25K. I'm going to go 10K in the middle. All right. What do we got here? Holy what? No, who pays that much?
Mate, I had a pair of the 1985 Jordan 1 OG Chicago's. I actually had those shoes. I had them. I reckon I bought them for $50. I wore them. I trashed them. And had I just kept them in the box, I could have whacked them on StockX, and that's the highest bid.
That is unbelievable.
So
well, there you go.
Are now buying and exchanging and storing. So people are buying these things en masse, these types of future trends in clothing. They're actually buying them en masse, limited source of these things because of the perceived value. Like Julie's comments.
Julie fucking Fletcher, quote unquote, that's fucked. Love it, Jules. Oh, so it's crazy,
most billionaires might be able to mortgage their most significant asset and maybe buy a pair of these retro Ford Jordans. But it goes to show, and so this is live, Jace. You can go jump on to StockX. There's no promotion here, but you can go on, have a browse around at what people are actually buying, what prices they're paying for them. And this gives you an idea that this fundamental understanding of what value is, and going back to Sydney airports, what constitutes a bid of that size to take over a company, 22 odd billion, 27 billion, whatever it was.
Yeah.
What is their rationale behind that? Where do they see the value? Because it is always where people see the value. And in this StockX website, it's incredible. You can go in there and you can see these sorts of outrageous prices. I was having a chat with the team earlier on, and I had this same sort of gig, and one of them said 900,000. I'm like, oh, that's a bit bloody bullish. Because the first time I looked at the pair of shoes on the top left, I read it as 139,000, and I thought that was ridiculous. And then I realized it wasn't a full stop; it was a comma, and there were 3 digits after it. 139.
Oh.
So be aware that the way that people are looking at value is changing, and it is changing rapidly. So is it an investment? Oh, arguably the Gucci handbag, probably not. For those who love the Gucci handbags, probably not. It is still going to drop in value. But some of these things that are one-offs or small batches where people believe that this is an incredible store of value, that is where they're actually traveling, Jace. Unbelievable. You wouldn't think it in a million years, but mate, it's happening.
That is certainly quite crazy, Andy. I'm gobsmacked.
Can you believe it? Can you believe it?
Oh, there you go. And Allison's saying she's got a friend who they call them sneakerheads, and there you go. You have to seal them up, put them in the fridge, keep them fresh. That is something else. I'm blown away by that.
That's the kind of person's house that you go around to and you borrow their clothes, you whack on a pair of their sneakers, and they have a heart attack.
Yeah, it's like, I just chucked on some shoes. I'm just going to go out for a run. No, that's not what you do when you go to that person's house. But
So
mate,
the big theme of this is that be aware that there is a shift. There is a fundamental shift happening in the perception of where people see value and where people are going to invest their funds. Now, this is very, left of field, but there's not too many people in the world who can afford to pay 139 million for a pair of shoes. I'm flabbergasted as to know what they would do with it, but that's a store of value, and undoubtedly they'll probably get 139 million. Like, I can't even say it if they went to resell them, but that was the going bid. So be aware that what we see, or where we see value, fundamentally changes. And but we had some questions in and around iron ore prices. And I'll just, people's perception on value changes so rapidly. Have a look at this slide here. We were talking about BHP, Rio Tinto, so on and so forth. I had a session with Malcolm Palmer, one of our stock analysts and investors, a couple of nights ago for our private clients. And we were looking at the blue line there is short-term interest rates. And the red line there is the long-term interest rates. And so obviously we saw them sort of pick back up, and we were talking about inflation. But then that led to a commodity discussion. And so a lot of people started to think, well, or a lot of people have been asking about iron ore prices. So I've already spoilt this for you, but just in case you didn't look, what do you reckon BHP's EBIT was? Or EBITDA as a percentage? What do you reckon they punched in?
Percentage. I don't know. 25%, 30%?
Have a look at this.
64%. Oh, no.
Yep, have a look. Look, so BHP, these are astounding results, right? $37 billion earnings, net debt, 4.1 billion. Net debt.
Wow.
Like, that's a tiny ratio.
Yeah.
And a 64% EBITDA, right? Before depreciation and amortization. This is a company that's absolutely killed it. And so people are going, well, iron ore prices, have plummeted, but let's have a look at the reality and how quickly the expectations get reset over time. They produce it for around about $14 per ton. They're selling it for $160 per ton before it fell. Their average is between 60 and 70. 60 and 70. That's 100% increase on what they're normally selling it for. So they're scaled up and used to being able to belt it out every day of the week and get a good 30% profit or 30% EBIT. For those of you who don't know, EBIT is earnings before interest, tax. EBITDA includes depreciation and amortization, or excludes them rather. So they were punching out a good healthy one. That sounded bad, but they were punching out a good healthy EBITDA at $60 to $70 a ton when they were selling it for that, and they've been doing $160.
Because the devil's in the details, Andy, isn't it, with this stuff? As we all know, the newspapers like a good headline. Oh, it's over. Iron ore. Well, hang on. Just relax. They've got plenty of margin to compress there, and, they've been making hay while the sun shines. And one thing I do know is that Australia is one of the most efficient cost producers of iron ore in the world. And so we can, I think I was reading this article the other day, Andy, was 30 to 40% more efficient than any other iron ore miner producer in the world when it comes to the cost per ton to produce. And so basically, folks, what that article was saying, and I'm not an expert in this, but it was a pretty good article, was saying that pretty well Australia would be the last iron ore producer standing. The rest of the mines around the world would have to shut down because they couldn't produce at the dollars per ton that Australia can. So, no wonder. Yeah, there you go. You keep it low. You make hay while the sun shines. You tuck a couple of bucks away. Free cash flow of $19 billion. That would be pretty tidy as a buffer. And away you go.
And look, so that actually illustrates the quite incredible period of time that we've had. 37 billion in earnings, 19 billion free cash flow. Free cash flow. Just a night. So get ready. They're going to be in the market. They're going to be looking around. Look at mergers, acquisitions, takeovers. They're in there because look at their return on capital invested, 32%.
And look what they're doing now. They're in a bidding war with what's his name? Oh, I'm having a mental blank now. Not Twiggy. Is it Twiggy Forrester? Yeah, Forrester. Yeah. Yep. They're having a crack, aren't they? So there you go.
But that's the reason why they can do it. That number down there, that 32%. So what that is for everyone out there, 32%. That's return on capital invested. So when they invest $1 in expansion, they're getting 32% back. So do the math. If you're borrowing at $1, that gets taken off, and if you're borrowing at 1% or 2%, and then you punch out at 34%, then you end up with a 32% return on capital invested. Just to simplify it, to oversimplify it.
Yeah, and folks listening in, everyone, you're like, wow, these are big numbers. But listen, what this explains, and Andy, you and I have talked about this endlessly. Money, when it is then created by good times in smart businesses, they keep it moving. Now they're on the hunt for another deal. Like they know that cash will be trash. They'll have a buffer amount that they don't want to go below, and they'll find a deal, e.g., nickel or whatever they're looking at right now. They're arguing with Twiggy Forrester over. They're trying to buy. And they're using the money to make more money. That's what money's job is to do. And this is what I say to property investors all the time. There is zero value in you sitting on millions of dollars worth of equity that make you no money. And might make you feel warm and fuzzy every now and then, go, I got low debt. But okay, well, you got low income too, because that money by default, as the prices increase, your value to earnings ratio decreases. And your effectiveness, your deployment effectiveness on your asset ratios gets less and less. And it's an interesting one. We could all take a little lesson from some of these companies, I think, when it comes to just keeping some money moving, looking for a deal, whatever that is. I think it's a good little lesson.
And just to put it into context, if they went and approached Sydney Airports would still say, even with your free cash flow, you still can't quite buy us. So the two opposite sides of the coin. And perhaps just the last one, which is, whoops, I'm having a bit of a problem with my slide there, Jace. But the last one, whoops, is somebody came out, I think it was in the last couple of weeks, and started talking about buybacks and what was going on. So one of the big ones that's out there is Commonwealth Bank's buyback. And Commonwealth Bank had an absolute gangbuster year. A couple of different reasons is they had massive reserves tucked away for the expectation of big loan write-offs throughout COVID, and they had almost nothing. And so it was quite incredible. So they had all this money tucked away, ready for the bad stuff to happen, and it never actually happened. But now they're doing a buyback, and this is an interesting one. So let's think through this. So when you have massive profit as a business owner in 1 year, an unexpected massive profit, and you haven't figured out a way of utilizing the money, what do you end up with a big excess of?
Cash.
As a company. Well, yeah, but what else do you have a big excess of? That's tucked away. It's on your balance sheet. You've paid tax.
Yeah. Retained earnings.
And your franking credits.
Franking credits.
So as a result, CBA had a massive retained earnings and a large amount of excess franking credits, which they won't be able to use. So what they've done is they've actually issued a buyback, and I forget the full details. And Justin, pretty much on the money, mate. So they've actually issued a buyback, and most people have been looking at it. They're going, why would I give you back the shares at less than what they're worth today? And people are going, it just doesn't make sense, Andy. Like, why? It doesn't make sense. Well, the reason why is because they're buying that back, not all as capital, but as they're issuing the franking credits out in order to reacquire those shares. So effectively, you're getting the buyback with a massive a massive franking credit attached to it. So if you've got a lower interest, if you've got a zero tax rate because you've invested in your pension fund or something like that, and you're going to get all of the tax back, then this could actually be a really beneficial deal for you. But if you've got a full marginal tax rate, you're sitting there going, I don't get it. Here's the thing, Jace. I reckon there'll be hundreds of millions of dollars potentially, or let's say millions of dollars, where people who just sign the bloody thing, send it back, have no idea what they've just signed, and then go, yeah, it didn't really make a hell of a lot of sense. And no, it won't. There's been a couple of them that have happened, and Alison's gone CBA and the NAB. The NAB's actually a different story. The NAB isn't doing the same thing. It's not dusting off its excess franking credits. It's a different type of buyback. So when it comes to buybacks, buyer beware, because not all buybacks are built the same. And you should really chat with myself, guys like Malcolm from Joseph Palmer and Sons, because there is very specific ways that you can use this, which will benefit you. And there are ways that if you just sign on the dotted line, that ultimately you're just guaranteeing yourself a loss of money. So it's been an interesting one, Jace. Big year last year. Buybacks are on the board. Buybacks are happening left, right, and center. They're happening all around the world. Nobody really understands them, but huge amount of people participate in them. So buybacks, buyer beware.
There you go. And, that just means really at the end of the day, Andy, that there's excess cash and resources at certain levels that are looking to be redeployed, and some go hunting for a new deal, e.g. Rio's going looking for a new deal, where CBA and NAB will buy back their shares to bolster up their share price, share their value and earnings in the future. So, yeah, it's an interesting one, team. There you go. So Alison said she's done her homework, Andy. Good student, and should be talking to you next week. But, no, that's great, mate. Good to hear. And fabulous to get a bit of insight into what's going on your side of the fence, my friend. But I've got a couple of things that I wouldn't mind sharing with the team also when we have a look at a few things out there. I had the Sydney Airport.
We really are sharing a brain this Friday, aren't we?
I tell you, I had Sydney Airport on my list as well, and we talked about that, which is awesome. But you talked about the sneakers, and I was talking about, hey, what about this? And again, this is an interesting one because there's some knock-on effects afoot, folks, out there in the world, which we all should be paying attention to. Not only are people having paying more than they probably should for a pair of shoes, but also collectors started to buy up big in cars because we've got some really interesting things going on in the world of renewables, Andy. Where is it here? I've got this one here.
Jump back down there, Jason. What was the number underneath that car? Is that $170 million on the classic car down there? Is that? Am I reading that right?
It wasn't on that one car, but it was it said the wealthy dropped $470 million on classic cars in 3 days.
Holy smoke! You could buy 3 pairs of those sneakers for that, mate. I'm not sure whether you'd want the classic cars, would you?
Yeah, it's an interesting one. But like you said, where are people choosing to store their money and their wealth? I don't know. I don't understand cars and sneakers. I understand real estate, so I'm choosing to store it there. But what's firing a few of these things is, something like this on the right-hand side, Origin Energy, saying that it's now turning off some of its power stations for extended times amid a surge of renewables. And, it didn't take Einstein to work out that this was coming, and this is here. It's arrived. So if your exposure is in coal, maybe you want to have a relook at that sort of stuff and look at what's going on on the other side of the equation. But I thought the connection between some of the oil-based, the coal-based, fossil fuel businesses starting to struggle. And on the flip side, people are going, well, if classic cars are going out of fashion, we better start buying some because they're all going to be battery operated or electric into the future. Which there you go, collectibles time as we go.
Well,
I grew up with a $3,000 HQ Holden, Andy, and now you can't buy one for less than 20 grand. It's crazy.
My first was a Triumph 2000 twin 250 carbies. It was a 4-litre straight six, beautiful car, bucket seats, red leather, unbelievable.
Red leather,
very porno type car it was. It had 2 hot dog mufflers, and that was about it. Roared like a V8. But
I could just see you in that, Fenton.
So this one's Origin, but there's AGL, which is a stock that a lot of people have been taking interest in the same area. We're going to see a demerger of that probably later in the year. I'm not exactly sure when. And effectively, what's happening with AGL, I think, is they're splitting off into 2 separate businesses. So they're taking their retail business over in one direction. They're taking their infrastructure asset over into a different direction. And what we're starting to see, and I was having a good chat with Malcolm about this the other night, and also a good mate of mine, Freeman, who might be listening at the moment in the UK, or he'll listen tomorrow. Always likes to get the red hot tips from the Fenster beforehand. Just joking. He knows a lot more about this stuff than me. And he manages a responsible and renewable energy fund over in the UK and throughout Europe. And so the question that I asked in regards to this is, well, it's all very good while government subsidies are in the game, right? Because they build in a stop loss for renewable energies. Yeah. And you need the subsidized government support in order to get the technologies to a certain level and the infrastructure to a certain level for it to be self-sustainable and renewable. And so the question I asked Malcolm was, well, is it going to be policy-led or company-led? And it's a really tough one, because unless the Australian, in my view, unless the Australian government really come to the party and start to really subsidise this renewable energy movement, it will take decade longer to get there. Look at Europe. They are light years in front of us, probably 10, 15 years in front of us as far as renewables are concerned. They look back and they go, you have got a massive desert that is 3/4 of the country. Or 2/3 of the country. Like, what's going on? You guys are crazy.
You guys doing? Yeah, no one lives there.
Incredible opportunity.
Crying out loud.
But what's smart about what they're doing at the moment is companies like AGLs, like some of these infrastructure asset owners, they're actually building batteries and things like that on the land next to the current coal-powered stations. So you're probably going to see a lot of this. And the reason why I say this is there will be a tipping point. Don't know when, but there's going to be a tipping point, whether it's government policy led or whether it's company push through. Because at the moment, it's not green. We really don't have a green policy here, really, to be fair. We do have policies, but in comparison to globally, you would say we don't have them. And if the government step in and start to look at this space, mate, you will see it'll happen exactly, well, not exactly, it'll mimic what happened in Europe, and mate, they are flying over there. So it's a good one to watch.
It's certainly a good one to watch, and certainly, don't get left behind on it, I suppose, when it comes to this stuff. And that's probably part of, the reason that I wanted to sort of bring it up today and talk about it. Like, how does it affect us and our investment decisions? And, can we be smart about what we think might be coming? And also, but not jump at shadows, right? As well, when it comes to a few of these things, the jobless rate, falls to a 12-year low. Well, supposedly that's a good headline, but
I manipulated
people stop looking for jobs.
Well, they manipulated the statistics 4 times over the last 20 years. So
yeah, who knows which statistics are right? But I sort of put that one in there for me. But the real thing for me, Andy, is that there's a bit of a call from the big institutions to sort of remove themselves from the fossil fuel industry. So I do know, I think it was the Magellan Fund, one of the big ones, and I can't remember the exact figures, but they decided to divest of coal worldwide, and that was quite a bomb about 1.5 years ago, 2 years ago. So this move is on its way. But the big one for me, and certainly when it comes to the real estate world, is not profit, but wages growth is the thing we're waiting for. Really, it's going to be an indicator when it comes to the world of real estate. Right now, prices have risen around Australia and has nothing to do with wage growth, right? Our wages are the lowest, or well, there's been no wage growth really since the GFC. It's been flat or even slightly declining, as it's saying here. And how's that been affecting down here, the world of real estate? Well, Andy, it hasn't really had any effect on the movement of well, it's had an effect indirectly on the real estate prices because interest rates have been so low. All right. Interest rates, and this is an interesting one. I chucked this up this morning and I talked about this with everybody. It is now, as of 2021 or late, early 2021, the debt to household income ratio, it is no more expensive dollar for dollar to pay for a mortgage than it was in, say, 2003 right now, because the interest rates have been on a downward decline for such a long time. It has had nothing to do with our wages rising. The cost of a mortgage has decreased, so people's ability to service higher debt and pay a higher price for real estate was possible, and that combined converged with a supply issue we have in the Australian market right now, and is fueling some of these prices which we're seeing. And right now we're looking down at our cash rate, which is pretty low, up from or down from, a long way up a long time ago when it comes to the cash prices. So, it's interesting when we have a look at where we are. Andy, you talked about price to earnings ratio compressing, and we're seeing the same thing happening with rents. I did the calculations this morning with one of my clients. It was a few days ago, actually, but I talked about it this morning. My clients were concerned that their rents had dropped $50 from 2 years ago. And I said, well, how much has your interest rate dropped from 2 years ago? And their interest rate had dropped from 3.5 to 2.5, Andy. So their rent had dropped 7%, but their interest rate had dropped 29%. And they were better off from a cash point of view, receiving less rent. It's mind blowing. It's like, how do I reconcile this stuff? But there you go. And that compression is happening all over the place by the sounds of things, in the stock market as well as the real estate market as we go.
See, that's a great example. And you and I call it controlling the cash and moving the zero line.
Yeah.
This is a classic example of how investors get used to things being a single way over a period of time. And when that one metric that they're looking at is out of whack, they think that the world's gone troppo. Yeah. And you're always moving it in your favor, and you're not looking at the variance between now and then. You're literally looking at it on a one year sort of a cycle, or one going down, but you're not looking at relative to the others. And it's when you get into that mindset as an investor or a business owner that you start to make really bad mistakes, because you don't actually see the opportunity that's sitting in front of your face sometimes, or sometimes how well you've actually done. Because sometimes it's time to pull a pin. It's like, all right, we're there. It's time.
Yep.
Let's hit the button.
It's time to do. Yep, do the do. Yeah, absolutely. And, that's the sort of thing that you've got to think about as you roll in your investing. Is it, is it an isolated observation, or is it one in context? And, that's the, I love the old, according to who, compared to what, and so what, what does it look like, But we had a couple of questions. Julie had one question here, Andy. Where will the people move when immigration picks up? Which state? Well, Julie, if we use a line from a guy I know, he's quite famous for saying this. History mimic. What does it say? Things don't do exactly the same, but sometimes it mimics it. I think I butchered that, Andy. You fucking have to tell me the full.
I think I've already used it twice tonight. History
One
doesn't
wine
repeat
too
itself.
many.
But it's an
History doesn't
incredible
repeat.
mimic.
Sometimes it's a good mimic. So, Jules, when we look at the past, when we had immigration in Australia, the destinations that were the most popular destinations for the first place to land in Australia were Sydney and Melbourne. Okay, Sydney and Melbourne, they were fairly evenly split, depending on where you came from. But those two cities will receive the majority of people who move from somewhere else into Australia. What does happen as a flow-on effect is then after a period of time, people say, well, there might be somewhere better than bloody Melbourne, or there might be someone better than Sydney, and we move, and they tend to move to Southeast Queensland internally. And so that's the flow, and then obviously a bit of a smattering everywhere else. An interesting thing, Andy, and Julie, if you're still listening in, the government created, and I think, Andy, you were talking about what is regional. I said these movements last time we caught up, but what is the definition of regional? The government redefined regional for the purposes of migration. So you can now move. You can get a visa very easily to move to Newcastle or Geelong or Bendigo or the Gold Coast, in comparison to getting a visa to move straight into Melbourne or Sydney. So there's these regional visas right now.
Is that another lockdown joke, Jason?
No, it is not.
I can't get a visa to move any of those places at the moment.
Well, yeah. Well, no one can move there just yet as we go, right? So there you go. And Bob was saying, "Oh, Wollongong, yeah." And there you go, Bonnie Doon. Bob's moving to Bonnie Doon, and fair enough, Bob. If as you go, but yeah, I mean, regional. Michelle, depending on your circumstance, certainly if we have some observation of what's going on right now, the movements from the major cities. I showed this stat last time we caught up, Andy. Was the movements weren't that far, and I might just quickly show everyone what I was talking about, but it wasn't that far from the cities. All right, so even though there is a net gain in Southeast Queensland or the Brisbane area, most of the people who have moved out of Melbourne to somewhere else moved close to the city. They moved not too far away. And Andy, you brought up the question, what is the definition of regional when it comes to this stuff? So, team folks, I think what will happen in the future, and it not so distant, I think those localized regional maneuvers will return to Melbourne in force when it feels right to do so. And I think we will have international migration at a peak level. My call, I think I've said this many times now, my call is we are going to have 3 to 5 years of record migration into Australia. And it's going to be a fabulous time for real estate at that point in time as well. And I called it this morning, Andy. I've called within 2 to 3 years a rental boom kicking on. I think the interest rates will stay low. The government won't want to mess with the economy, nor will the banks when it comes to the interest rates. Imagine this, Andy. Imagine, 12 million Australians on a 2.5% interest rate, and then all of a sudden they've got to pay a 4.5% interest rate. That's huge.
Well, it blows up the stability of the financial system, right? Because ultimately we need the banks, the big four banks, which have the greatest amount of exposure to all of our domestic lending, which means our mortgages. So there's a counterparty to that. So if you blow up the whole system, right? And here's the thing: is we're not going to learn, Jace. We're going to keep taking on more debt. Like
What do you mean, Andy? What do you mean?
Because in theory, you should learn the lesson and you don't take on more of the debt. But then you go, well, actually, it's counterintuitive thought. The more debt that we take on, the less that they can teach us the lesson.
Yeah.
Right? And it's the old adage: if you owe a bank $1 million, you've got a problem. If you owe a bank $100 million, the bank's got an issue.
They've got a problem. Yeah.
And so they are hamstrung to a certain degree as to how they can lift these rates. And I brought up the same thing to Malcolm, and he said he'll come on and have a chat with us on Wine and Wisdom. He's like, "What, you drink wine and talk finance?" Like,
that's dangerous.
We've been doing it for a year, Malcolm. Have you not been watching? So clearly he doesn't watch what we do. But I asked him the same question. I said, Malcolm, look, Japan never been able to get off zero. Hasn't been able to get off zero. US, Europe. Europe even said the central bank in Europe basically said that we will allow inflation to not verbatim go off its tits. She doesn't really speak like that, but we'll allow for inflation to spike and go crazy at periods of time. We're going to but we're looking for wage growth. We don't care so much about inflation. We're happy for that to go up and down, and we've spoken about this previously because supply chains are having such a big impact. We don't know what's real inflation and what's not real inflation at the moment because some of it's based on supply, some of it's based on normal market conditions. But so the central bank in Europe, no, they're going, no, we're staying low until there's wage growth. Well, like you said, Jace, hasn't been around since the GFC, which is a while ago. And same thing out in here, but also if you look at the greater sophisticated economies, of which we are not one of them. So Japan of the world, the United States, so on and so forth. Malcolm actually said, well, the difference between us and them, and it's very possible that they will stay low for a long, long time into the future. But mentioned that we are a commodities-based country. And so that was his little tidbit to kind of go, buyer beware, because our interest rates will probably reflect the journey of the commodities over a period of time, which was a really interesting connection, which I think we should get him on to talk about.
Yeah, I'd love to hear about that. Yeah.
But what that, to me, in the back of my head, it starts to go, well, we have to have a commodities boom, which means we get wage growth, which means that interest rates can rise.
Yeah, well,
but if we don't see that,
if you don't get it, how can you raise the interest rates? Because what's happened, Andy, and whether it's been, engineered or not, wage growth has been zero or flat. And the only way to engineer free cash flow for the society has been to drop the interest rates, right? So technically, if you take everything off the table, that's what fueled prices in properties growing, all right? Justin is really impressed with your technical terms when it comes to...
Well, you know what? I try and keep it as technical as possible while making sure that everybody understands.
That's it.
I reserve that. The homoscedasticity of our inflation needs to go to a more homo status than heteroscedastic nature. I prefer just let it go off its tits.
Love it, Fenton. Love it. Well, Jules, listen, I don't think this would ever be possible, Andy, and and ever's a big claim, but how could it even be possible for interest rates to get back anywhere near that without the whole economy imploding? And my call would be maybe interest rates would march from 0.5% to a full percent up in the next 5 years. That would be my call, if at all. That's my call.
I reckon the next 10 to 15 years, you will see people paying off their house with 20% interest rates. That's my bag, but it's not en masse. It is based on a risk-weighted mortgage. And my belief, and we've spoken about this, and it's not a general consensus, it might be 20 years. But I reckon that I'm right, and I reckon it'll go in this direction. But one way that interest rates can decouple from economies is where Julie, you might have a rip-roaring business that is just smashing it, right? But you're reinvesting in the business. You've got no major profits to show that aren't being reinvested. So you're skinny, cash poor, and the banks can see that. And they will, maybe it's not a bank, maybe it's a second-tier lender, and they say, well, look, I reckon you should have a house as well. And it's quite clear that you will be able to continue to pay this because business is flying. So you can afford to pay 20%. So here it is. You want that $1 million house, you can have $1 million at 20% per annum, and we'll reassess your ability to maintain the coverage of that loan on an annualized basis. And if you become less risky, we will lower the rate. If you become more risky, we'll raise it. I reckon it's on the cards for the next 10 to 20 years somewhere.
Yeah, I reckon, and folks, just to be clear, what Andy's talking about, he's not talking about the banks raising interest rates. What he is talking about is pricing interest rates appropriate to the borrower at an individual level. What that means will be, I believe, Andy, the technology's there now. I believe that pricing instrument's there, and I'm with you. And I think that should be appropriate, personally, as we go. And the previous, 100 years of lending is archaic when it comes to now the speed of information and capacity for us to manage and, understand a borrower. It's like low doc on steroids, Jules. Yep. Yeah, low doc on steroids. And so it should be. I mean, crying out loud. I mean, if you and I talked about, what can we say? Something weird about, bouncing balls or something like that. I don't know. We say it out loud, and 5 seconds later, it's probably a bad thing. I've had too much wine, but I'm trying to, 5 seconds later, it'll be on our bloody phone. I mean, everything's connected to everything. There's data for the Kahoozies, and at the end of the day, we'll see. It's an interesting one, Bob. This is interesting, and I've chatted about this stuff. But what will happen as an individual, as Jason or Andy or as Bob borrowing money? What the laws have set up, and you're right. There are laws that do not allow this type of lending. However, if Andy Fenton borrows some money as a PTY Limited company, the gloves are off, so to speak, team. Okay, and you are now outside the rules of the lending rules right now. And to be honest, I just settled a property, Andy, just right now, low doc loan, completely outside of the rules that provide protections for individual borrowers, and the banks have to abide by. But there will be lenders, team, gang. There will be lenders everywhere that will be doing this. And Andy, I'm pretty sure I sent you these ads not so long ago, actually, and I'm like, I'm going to have a look at this. Private lending advertising on Facebook. I remember sending it to you, but I'm trying to find it.
Yes.
Now.
From the family office, but I think
from the family office.
Maybe we'll keep that one off the air just so that we don't get sued at some point in time.
All right, keep that one up there. Good call. But Bob, it's already happening.
Not by us, just by the buyer.
Not by us, but professional family offices. Anyway, so
and let's be frank, is that Facebook, Google, they're all looking to play this game. All right. And here's the thing. If they want to play the game, the game
Google
will
have
be played.
got banking licenses already, Andy.
Right. But here's the other thing, is that the scary part about these companies taking over the world, which they will, I think it's inevitable in some way, shape, or form, because every government is rules-based. It's constitutional-based. My perception is that I believe that there are certain things that are going on now that are anti-constitutional. But the only way that you can override, so let's just say allegedly, Jace, that some of the laws that they're passing in their little politicians club, let's just, for argument's sake, I'm not saying that they are, but let's just, as a hypothesis, as a random thing, let's just say that some of the rules that they were passing weren't actually what we'd call legal rules. And what I mean by that is that there's a precedent that was set previously that basically makes the new legislation not legal. or not legally binding, or it goes against parts of our constitution, which is the founding framework of the legal system that we operate in. That law is law until it's not law. That law is law until somebody challenges it, and then somebody finds a precedent in the Supreme Court and it gets overrun, and a greater precedent says, okay, well, that's adjusted. Or it goes up to the High Court, all right, and the High Court then can adjust the Constitution or say that that's anti-constitutional. We can't do that, right? Because your average Joe, you and me, if we would spend our lives fighting it to get it up to the High Court, and somebody probably neck us on the way through, maybe, don't know. But ultimately, to get up there would cost a huge amount of money beyond the means of your average person. These companies, $156 billion sitting in the war chest of Apple, do you think that they could give a flying rat's ass about taking something right up to the High Court to test whether the precedent would sit, or test whether the law would sit, or whether if they can find their way in and go, all right, here's how we can give people what they want around Australia? Do you think that they're going to even balk at throwing $1 billion at it when they know what's on the other side?
They'll be right there. And like you said, Andy, it's the resources, in this stuff. And, we might save that one for another day. I'd love to see us get, your crew on, Palmer and Sons, come on and talk about that stuff, because, when you rise out of the retail space, it's a very protected, what would I say? I mean, naive is not the right word, but it's protected and there's a lot that goes on.
Landscape,
yeah. And you rise up into another world when it comes to the ability to borrow outside of the norms. Folks, I think I'll tell you this story one day, but I remember borrowing $10 million in about 13 minutes over a cup of coffee. I've found it harder to borrow $5,000 and qualify for a credit card, for crying out loud, than I did to borrow $13 million to buy a property. The levels of scrutiny and due diligence and stuff and protection mechanisms are different at different levels, and it's just mind blowing. So we might save that one for another day, Andy. I think that would be quite a good conversation.
To be fair, it was a pretty good coffee.
It was a great coffee. But there you go. But you're dead right, Andy. You said if you owe more than if you owe $10,000 and you can't pay it, then you're in trouble. But if you owe $10 million and you can't pay it, well, they're in trouble. I might tell folks that story one day, but there you go. I've had those moments over the last 25 years of investing, and Fenton's had one or two interesting moments too. So there you go, folks. I think we might call it Andy, because I've had too much to drink and we'll probably just dribble on right now.
I reckon it might be that you've actually just poisoned yourself with the old wine that you've been drinking that's now 3 weeks old. It's the reason why you don't drink, mate. It's not because you don't like to have a drink. It's because when you drink wine like that's been sitting there for 3 weeks, you're actually poisoning yourself. And this isn't drunk. This is like 911. Call the hospital on your way, Jason.
There's something wrong with him. Well, mate, awesome to hang out with you and have a good chat. Hopefully, folks, there was something of interest or you learned something tonight. I certainly did. Certainly, the price to earnings ratio was fascinating for me, Andy. It's compressing in the world of the share market, and it's certainly compressing in the world of real estate right now. It's certainly something to observe and keep an eye on as we go. I think Christina's right. I think I've lost the plot. There's probably time for me to check on out.
Mate, words of wisdom right the way through, my brother. Absolutely, every single week, 100%.
Awesome. All right, well, folks, that's it. We're done and dusted. Well, I think it's a good night from me.
And it's a good night from him.
Good night.